$1.2 trillion. That's how much wealth vanished from crypto markets in just 42 days. Evaporated, gone, ceased to exist. Bitcoin, the supposed digital gold, the revolutionary asset that was going to replace the dollar and make everyone rich, crashed from $126,000 to $80,000. A 36% collapse that wiped out hundreds of thousands of traders and billions in paper wealth. And here's what I want you to understand right from the start. I called Bitcoin rat poison squared back in 2018. And now that poison is working through the system exactly as I predicted it would. The only question left is how much more pain investors will endure before they finally accept what should have been obvious from day one. Let me start with the most fundamental problem, the issue that makes everything else irrelevant. Bitcoin produces nothing, absolutely nothing. It has no intrinsic value whatsoever. When you buy a farm, that farm produces corn or wheat or soybeans, whether you check the price every day or ignore it for a decade. The production happens independent of market sentiment. The value creation is real and tangible. You can eat the corn, you can sell it, you can feed it to livestock and create more value. The farm produces wealth year after year after year. When you buy an apartment building, it generates rental income every month. When you buy stock in a productive business like Coca-Cola, that business sells billions of drinks and generates billions in profit that flow to shareholders through dividends and retained earnings that get reinvested to create more value. These are productive assets. They create wealth. They don't just sit there hoping someone will pay more for them tomorrow. Bitcoin does nothing. It sits in a digital wallet. It doesn't produce earnings. It doesn't pay dividends. It doesn't generate cash flow. It doesn't invent new products or serve customers or create jobs or build infrastructure. It just exists, waiting for you to sell it to someone else, hopefully at a higher price. And here's my famous line that Bitcoin enthusiasts absolutely hate. If you offered me all the Bitcoin in the world for $25, I wouldn't take it. What would I do with it? I'd have to sell it back to someone else immediately because it does nothing for me. That's not investing. That's speculation. That's the greater fool theory dressed up in technical jargon and revolutionary rhetoric. Now, let's talk about the $600 billion that never actually existed in the first place. This is crucial to understanding how bubbles work and why they always end in tears. Market capitalization is a phantom number created by collective delusion and mathematical illusion. Here's how it works. There are 19 million Bitcoin in existence. But here's the shocking truth that nobody talks about. 93% of Bitcoin hasn't moved in over a year. It's just sitting there. The price that you see on exchanges, the 100,000 or 80,000 or whatever it is when you're watching this, that price is determined by marginal trades. Maybe 1% or less of all Bitcoin actually trading. But then we take that marginal price and multiply it by 19 million Bitcoin and declare that the total market cap is 1.5 trillion or whatever the number is. That's insane when you think about it. We're valuing millions of Bitcoin based on what a tiny fraction traded for. And when the marginal price drops, billions of dollars of supposed wealth disappear instantly across the entire supply, even though nothing actually traded. It was never real wealth. It was paper wealth built on the assumption that everyone could sell at the marginal price simultaneously, which is mathematically impossible. The liquidation catastrophe of October-November should have been a wake-up call for anyone paying attention. On October 10th alone, $19.16 billion was liquidated in a single day. $19 billion gone in 24 hours. Why? Because Trump made a tariff announcement and the macro environment shifted slightly, and suddenly everyone who was leveraged long on Bitcoin got wiped out in a cascading series of forced liquidations. Then on November 14th, another $1.1 billion evaporated, and 246,000 traders got completely wiped out. Their accounts went to zero. Years of savings, in some cases life savings, gone in hours because they were using leverage to bet on Bitcoin going up and the market went the other direction. And here's the terrifying part. 70% of those positions were longs. Everyone was on the same side of the boat. Everyone was betting on the price going up. Nobody was hedging. Nobody had a plan for what happens if the narrative breaks. And when everyone is on the same side of a leveraged trade, the reversal is absolutely brutal. The ETF exodus tells you everything about what the smart money is actually doing versus what they're saying publicly. In January 2024, when the Bitcoin ETFs launched, the narrative was all about institutional adoption. Wall Street is finally embracing crypto. This legitimizes Bitcoin. The floodgates of institutional capital are opening. That was the story. And for a few months, money did flow in. But then reality set in. On November 13th alone, $870 million fled Bitcoin ETFs in a single day. That's not retail investors panic selling small positions. That's institutional money running for the exits. In just 3 weeks, $2.6 billion in net outflows from Bitcoin ETFs. And Ethereum ETFs are even worse, seeing $729 million in weekly outflows. This isn't adoption. This is rejection. The smart money experimented with crypto, realized it doesn't fit into a rational portfolio framework, and is now exiting as quickly as they can without completely crashing the market. The greater fool theory is playing out in real time, and it's fascinating to watch if you're not the one losing money. The crypto market cap peaked at $4.4 trillion. Think about that number. $4.4 trillion of supposed wealth. Then it dropped to $3.2 trillion. $1.2 trillion ceased to exist. Where did it go? Nowhere. It was never really there in the first place. It was paper wealth based on the assumption that new buyers would keep coming in at higher and higher prices forever. The Fear and Greed Index, which measures market sentiment, hit 11. That's extreme fear. The same levels we saw during the FTX collapse when Sam Bankman-Fried's fraud empire imploded and took billions down with it. But here's what's revealing. There was no single catastrophic event this time. No major exchange collapse. No regulatory ban. No dramatic fraud revelation. Just the slowly dawning realization that maybe Bitcoin isn't actually worth what people were paying for it. Reality reasserted itself. The collective delusion weakened, and the price collapsed. Let me explain the leverage death spiral, because this is critical to understanding why crypto crashes are so much more violent than traditional asset crashes. When you use 10 times leverage, that means you're borrowing $9 for every $1 you put up. A 10% move against you wipes out your entire position. You go from having money to having nothing in minutes. And here's what happens. As Bitcoin drops, leveraged positions get automatically liquidated. Those forced sales push the price lower. That triggers more liquidations, which pushes the price lower again, which triggers even more liquidations. It's a death spiral that feeds on itself. And we're seeing technical formations that veteran traders recognize as extremely bearish. The death cross formation appeared for the first time in 3 years. That's when short-term moving averages cross below long-term moving averages, signaling that momentum has decisively shifted to the downside. And what did traders do after getting obliterated in October? Did they learn their lesson? No. They leveraged up again. They convinced themselves it was just a temporary dip. They bought the dip, and then they got liquidated again in November. It's financial Darwinism playing out in real time. The Federal Reserve reality check is something crypto enthusiasts desperately want to ignore but can't. Interest rates are staying higher for longer. The probability of a December rate cut has dropped below 40%. The free money era is over. When I can earn 5% completely risk-free by buying Treasury bills backed by the full faith and credit of the United States government, why on earth would I put money into Bitcoin, which has massive volatility, no cash flows, regulatory uncertainty, technological risks, hacking risks, and no fundamental valuation framework? The risk-return calculus made sense when interest rates were zero, and desperate investors were searching for any return anywhere. But at 5% risk-free rates, Bitcoin needs to offer significantly more than 5% expected return to compensate for the massive additional risk. And it can't do that anymore because the easy money has been made and the marginal buyers have disappeared. Every bubble in history looks the same if you study them long enough. The details change, but the pattern is identical. During the dot-com bubble in the late 1990 seconds, the narrative was the new economy. Old valuation metrics don't apply anymore. Profits don't matter because we're building the future of commerce. Eyeballs and page views are what count. Companies with zero revenue were worth billions because they had a website and a .com name. And then it all collapsed. 90% of those companies went to zero. Trillions in wealth evaporated. During the housing crisis, from 2004 to 2007, the narrative was, housing prices only go up. Land is scarce. Everyone needs a place to live. You can't lose money in real estate. People were buying houses with no money down using subprime mortgages. They couldn't afford because they assumed they could flip the house for a profit in 6 months. And then it all collapsed. Housing prices fell 30, 40, 50%. Millions lost their homes. Banks failed. The entire financial system nearly imploded. And now with crypto, the narrative is digital gold, decentralized future. The dollar is going to collapse. This is the future of money. It's the same pattern. Elaborate intellectual theories about why old rules don't apply this time. Momentum begets momentum as prices rise and attract more buyers. Skeptics get mocked as dinosaurs who don't understand the new paradigm. And then reality reasserts itself and the bubble pops, and everyone who bought late loses everything while the early promoters who sold near the top get rich. The digital gold myth was always nonsense, and watching it get destroyed in real time is satisfying for someone who's been warning about this for years. Real gold has thousands of years of history. It's been used as money and a store of value across civilizations and continents. It has physical properties that make it useful for jewelry and certain industrial applications. And even with all that, I don't like gold as an investment because it doesn't produce anything. It just sits there. You can't eat it. It doesn't throw off cash flow. Your returns depend entirely on selling it to someone else later at a higher price. But Bitcoin doesn't even have gold's properties. It doesn't have thousands of years of history. It doesn't have industrial uses. It doesn't have aesthetic beauty. It's just data on computers. Lines of code that exist only because a network of computers agrees to maintain the fiction that they represent value. And that agreement is fragile. If the network of miners decides it's not profitable to maintain the network, if governments crack down hard enough, if a better alternative emerges, that agreement dissolves and Bitcoin goes to zero. The inflation hedge lie was exposed brutally in 2021 and 2022, and people still haven't learned the lesson. When inflation was running at 8 to 9%, when prices were rising at the fastest rate in 40 years, Bitcoin crashed 77%. 77%. The supposed inflation hedge lost 3/4 of its value during the biggest inflation spike in decades. That tells you everything you need to know about Bitcoin's supposed utility as an inflation protection asset. Real inflation hedges are productive businesses that can raise their prices to offset rising costs. The Nebraska Furniture Mart that we own, when their costs go up, they raise prices and maintain margins. Their earnings power adjusts with inflation. When Coca-Cola's costs rise, they increase prices and consumers keep buying because the product has real value. These businesses have pricing power because they produce things people need and want. Bitcoin can't adjust its earnings power because it has no earnings. It has no pricing power because it produces nothing. It's just a token whose value depends entirely on what the next buyer will pay. During inflation, when money is losing value, people want productive assets that generate growing cash flows, not speculative tokens that sit in digital wallets doing nothing. The blockchain versus Bitcoin distinction is something people still don't grasp. The internet was genuinely revolutionary. It changed commerce, communication, entertainment, education, everything. But that didn't mean every internet company was a good investment. Pets.com had a great idea and used internet technology and went bankrupt anyway. The technology being useful doesn't automatically make the companies or tokens built on it valuable. Blockchain technology might indeed be useful for certain applications, maybe supply chain tracking or record keeping or smart contracts. Fine. But Bitcoin itself is poorly suited for actual commerce. The transaction speeds are too slow. The energy costs are absurd. The volatility makes it useless as a medium of exchange. No rational person wants to buy coffee with an asset that might be worth 30% more or less tomorrow. Bitcoin has proven to be a speculative asset, not a useful currency. And speculative assets that don't produce anything eventually go to zero when the speculation stops. The scarcity fallacy makes me want to laugh every time someone mentions it as a serious argument. The fact that there will only ever be 21 million Bitcoin is completely irrelevant to its value. I could create Buffett bucks tomorrow and decree that there will only ever be 21 million of them. That doesn't mean they're worth anything. Scarcity only matters if people want the scarce thing. Coca-Cola is scarce in the sense that there's only one Coca-Cola company with that specific brand and formula. Apple is scarce. BNSF Railroad is scarce. But they're valuable because they're scarce and they produce earnings. You know what else is scarce? My personal collection of used coffee cups. There will only ever be exactly the number that exists right now. They're completely scarce and unique. They're also worthless because nobody wants them. Scarcity without demand is meaningless. The Ponzi dynamic is undeniable if you look at the structure honestly. Bitcoin's returns don't come from value creation or production. They come from new money flowing in and buying from earlier holders. That's the definition of a Ponzi structure. It doesn't mean it's an intentional fraud like Bernie Madoff. It means the structure mathematically requires new buyers to generate returns for existing holders. And what happens when new money stops flowing in? We're finding out right now in real time. The $2.6 billion in ETF outflows is the prop being kicked away. The institutional money that was supposed to provide a stable bid isn't coming anymore. It's leaving. The retail traders who were leveraged long got liquidated and lost their capital, so they can't buy more. Who's left to push the price higher? The market is discovering that the emperor has no clothes, and there's no fundamental value underneath to catch the fall. So what should you do if you own Bitcoin? I'm not going to tell you to sell. I don't give specific investment advice to individuals, and I don't believe in trying to time markets. But I will tell you to ask yourself a fundamental question. Why do you own this asset? If the answer is because you think the technology is revolutionary and you believe in the future of decentralized currency and you're willing to lose all your money in pursuit of that vision, fine. That's a conscious choice. But if your answer is because you think someone will pay more for it tomorrow than you paid today, if your only thesis is number go up, then you need to understand that you're not investing. You're gambling. You're speculating. You're playing a game of musical chairs and hoping you're not the one left standing when the music stops. And the music is stopping right now. Can you hear it? The distinction between productive assets and speculative assets is something I've tried to teach for decades, and most people still don't get it. Productive assets generate value regardless of what they trade for. Speculative assets only have value based on what someone else will pay. Stocks are productive assets representing ownership in businesses that make things and provide services. Real estate can be productive if it generates rental income. Bonds generate interest payments. Bitcoin is purely speculative. It has no productive capacity. Its only value is what the next buyer will pay. And when buyers disappear, so does the value. We're watching that happen right now in slow motion. Maybe the bounce back, maybe there's another wave of enthusiasm and the price spikes back up. But each cycle brings fewer new buyers and more skepticism, and the ultimate destination of zero gets closer. I've been investing for 7 decades. I've seen every kind of bubble, every kind of mania, every kind of speculative excess you can imagine. I've seen gold rushes and tulip manias and railway bubbles and technology bubbles and housing bubbles. And they all end the same way. Greed drives the price higher until the marginal buyer can't afford it or won't pay it. Fear takes over, the narrative breaks, the price collapses, and the latecomers lose everything while the early promoters who sold near the peak get rich. This time is not different. It's never different. The details change, the technology might be new, the story might sound compelling, but the underlying dynamics are identical. Human nature doesn't change. Greed and fear don't change. Math doesn't change. And the math on Bitcoin is simple. It produces nothing, it's worth nothing, and it's going to zero eventually. To be specific about what going to zero means, Bitcoin's value is based entirely on collective agreement that it has value. That's a fragile foundation. It requires a critical mass of people to continue believing the narrative and continuing to buy. When that agreement breaks down, when enough people decide Bitcoin isn't worth holding anymore, there's no floor, there's no intrinsic value to catch the fall. It's not like a stock in a profitable company, where eventually the valuation gets cheap enough relative to earnings that value investors step in. Bitcoin has no earnings. It has no book value. It has no assets. Zero is the mathematically correct value for an asset that produces nothing and exists only because people agree it has value. And agreements break down. That's what we're witnessing right now in the early stages. The fear and greed index at 11 means people are starting to wake up. The ETF outflows mean institutional money is running. The leveraged longs getting liquidated means retail speculators are being wiped out. Each wave of selling removes the marginal buyers who might support the price. Each disappointment shakes more believers out of their conviction. Be fearful when others are greedy, and greedy when others are fearful. That's my famous line, and people quote it constantly. Right now, everyone wants to know if this means I should be greedy about Bitcoin since there's fear in the market. No. That line applies to productive assets that are being irrationally sold. When great businesses are being dumped because of temporary fear and their stocks trade below intrinsic value, that's when you buy. Bitcoin has no intrinsic value. The fear is finally, belatedly rational. Be fearful when others are greedy doesn't mean be greedy about speculation when the speculation is collapsing. It means avoid the speculation entirely and buy productive assets when they're irrationally cheap. I started this by telling you that $1.2 trillion vanished in 42 days. Let me end by saying that the rest of the supposed crypto wealth will follow the same path. Maybe not tomorrow, maybe not this year, but eventually, inevitably, Bitcoin goes to zero. The only question is how long it takes and how much more money gets lost along the way. If you're smart, you'll exit while there are still buyers. If you're lucky, you'll break even or maybe even make a profit. But if you're holding for the long term, waiting for Bitcoin to replace the dollar and make you rich, you're going to learn an expensive lesson about the difference between investing and speculation. And by the time you learn that lesson, your wealth will have evaporated just like that $1.2 trillion. Don't say you weren't warned. Let me elaborate further on why the farm analogy is so important to understanding the fundamental difference between investing and speculation. When I buy a farm for $600,000 and it produces $60,000 a year in crops, I'm getting a 10% return on my investment regardless of whether anyone wants to buy the farm from me. The farm's value to me as the owner is the stream of future production it will generate. If farm prices drop by half tomorrow, I don't care because I'm still getting my $60,000 a year. In fact, I'd be happy because I could buy more farms at better prices. But Bitcoin produces zero, not $1, not 1 cent, not 1 Satoshi of actual economic output. So the only way you profit is if the price goes up and you sell to someone else. You're completely dependent on market sentiment, on the psychology of other investors, on the greater fool being willing to pay more than you did. That's not a foundation for sustainable wealth creation. That's a gambling mechanism dressed up in technical language about blockchain and cryptography and decentralization. And here's something that should terrify anyone who's paying attention. The demographic of Bitcoin investors skews young and tech-savvy and ideologically motivated. They believe in the narrative. They've convinced themselves that they're early adopters in a financial revolution. But what happens when that demographic ages and life circumstances change? When they need to cash out to buy houses, pay medical bills, fund retirement? There's a massive overhang of Bitcoin held by true believers who haven't sold yet because they believe in the ideology. When that ideological fervor fades, when practical needs overwhelm revolutionary ideals, the selling wave will be biblical in its proportions. The liquidation mechanics are worth understanding in detail because they explain why crypto crashes are so much more violent than traditional market sell-offs. In traditional stock markets, there are natural buyers at certain prices. Value investors step in when stocks get cheap relative to earnings. Pension funds rebalance. There are fundamental anchor points. But in crypto, there are no fundamental anchor points. A stock might be overvalued at 30 times earnings, but undervalued at 10 times earnings. Bitcoin could be overvalued at 80,000, but it could also be overvalued at 10,000 or 1,000 or 100. There's no earnings multiple to calculate, no book value to reference, no replacement cost to consider. It's pure sentiment all the way down. So when the selling starts and leveraged positions get liquidated, there's no natural stopping point. The price can fall 5, 10, 20%, and there's no fundamental reason to buy. It can fall 50% and there's still no fundamental reason to buy. It can fall 90% and there's still no fundamental reason to buy because the fundamental value is zero. The only thing that stops the decline is when enough speculators think they can sell it to other speculators for more. That's not a bottom. That's a temporary pause in an inevitable decline. The ETF situation reveals something critical about how institutional money actually thinks versus what they say publicly. When the Bitcoin ETFs launched, there were press releases and Analyst reports and cable news segments all talking about how this was legitimizing crypto and bringing in institutional capital and representing mainstream acceptance. But look at the actual flows. Look at what the money is doing, not what the press releases say. The money came in for a few months, experimented with the asset class, found it lacking, and is now leaving. That tells you everything. Institutional portfolio managers aren't ideologically committed to crypto. They're not believers in the revolution. They're fiduciaries charged with generating risk-adjusted returns for their clients. When they run their models and stress tests and scenario analyses on Bitcoin, they can't find a coherent role for it in a portfolio. It's too volatile to be a reliable store of value. It's too speculative to be a safe haven. It's not correlated with anything useful for diversification purposes. It has no yield. It has no fundamental valuation framework. So they allocated a small experimental position, tested the thesis, and are now exiting. The smart money already knows the answer, and they're selling to retail investors who are just figuring it out. Every bubble has its intellectual champions, people who construct elaborate theoretical frameworks to explain why this time is different and why old rules don't apply. In the housing bubble, it was sophisticated financial engineers explaining mortgage-backed securities and collateralized debt obligations and how slicing and dicing risk made it disappear. In the dot-com bubble, it was network effects and first-mover advantage and land grabs in the new digital economy. Everyone sounded smart. Everyone had data. Everyone had compelling arguments. And they were all wrong because they were justifying prices that had become detached from reality. Bitcoin has its intellectual champions too. They talk about Austrian economics and the declining value of fiat currency and decentralized trustless networks and programmatic scarcity. It all sounds sophisticated and well-reasoned, but it's fundamentally the same mistake, constructing intellectual scaffolding to justify paying prices that don't make sense for an asset that produces nothing. All the fancy economic theory doesn't change the fact that Bitcoin's value depends entirely on the next buyer paying more. The comparison to gold is instructive because even though I don't like gold as an investment, Bitcoin fails even by gold's limited standards. Gold at least has thousands of years of cultural acceptance as a store of value. When I say I don't like gold, it's because it just sits there and doesn't produce anything. But millions of people around the world view it as money or wealth preservation. That agreement has held for millennia across different civilizations. Bitcoin has 15 years of history, mostly as a speculative trading vehicle. The idea that Bitcoin has somehow achieved gold status after 15 years is absurd. And gold has physical properties that make it uniquely suited to certain uses. It doesn't corrode, it's beautiful, it's malleable, it has industrial applications in electronics. Bitcoin has none of that. It's bits and bytes that require electricity and computers to even access. If the power grid fails, if the internet goes down, if governments crack down on crypto exchanges, your Bitcoin might as well not exist. At least with gold, you can hold it in your hand. The inflation hedge narrative was always transparently false to anyone who thought about it seriously. Inflation is bad for holders of non-productive assets because the purchasing power of your nominally fixed holdings erodes. If you have a bar of gold and inflation is 10%, you need the price of gold in dollar terms to rise by at least 10% just to maintain your real purchasing power. Same with Bitcoin. It's not generating cash flows that inflate with the currency, so the nominal price has to rise just for you to break even in real terms. But productive businesses are different. If I own See's candies and the dollar loses value, See's raises the price of candy. Their costs went up, so prices go up, and the business continues generating real value. The earnings in nominal dollar terms grow with inflation, while the real economic value stays the same. That's a true inflation hedge. Bitcoin advocates completely misunderstood this distinction and got destroyed when actual inflation arrived. The transaction cost and energy consumption of Bitcoin are disqualifying even if you ignore everything else. A single Bitcoin transaction uses more energy than a typical American household uses in a month. The Bitcoin network as a whole consumes more electricity than entire countries. That's not sustainable. That's not scalable. If Bitcoin actually became a widely used currency, the environmental and infrastructure costs would be staggering. But Bitcoin maximalists hand-wave this away with arguments about renewable energy or excess energy or whatever. It doesn't matter. A payment system that requires that much energy per transaction is fundamentally broken as a medium of exchange. And the transaction speeds are laughably slow. Bitcoin processes about 7 transactions per second. 7. The Visa network processes thousands per second. If Bitcoin were actually used for commerce at any real scale, the network would grind to a halt. The transaction fees would skyrocket as people bid for limited block space. It's not a viable payments network. It's a speculative asset that people trade on exchanges. The entire original vision of Bitcoin as peer-to-peer electronic cash failed. It became digital gold according to the new narrative, but even that narrative is falling apart as we speak. I want to be absolutely clear about what zero means in practical terms because people sometimes misunderstand this. When I say Bitcoin is going to zero, I don't necessarily mean it will literally trade at zero. I mean, it will lose effectively all of its value relative to productive assets and will become an irrelevant curiosity. Maybe it trades at or with some tiny group of true believers maintaining the network for ideological reasons. But the supposed trillion-dollar asset class, the revolution in money, the digital gold phenomenon, that goes to zero. The process might take time. Bubbles often take longer to deflate than people expect because there are always fresh waves of greater fools, always new narratives to justify holding, always brief rallies that make people think the bottom is in. But the ultimate destination is certain. An asset that produces nothing and exists only because people agree it has value will eventually collapse when that agreement breaks down. And we're watching that agreement break down in real time with the ETF outflows, the liquidations, the fear index at extreme levels, the decline from 126,000 to 80,000 in a matter of weeks. People who got in early and sold near the peak made fortunes. Good for them. They understood they were playing a speculative game and they timed it well. But people who bought in the last few years, people who bought near the top thinking it was the future of money, they're going to lose most or all of their investment. And they'll learn the same lesson that every generation of speculators learns, that betting on price appreciation without underlying value creation is gambling, not investing. And the house always wins in the end.